Hello, welcome everyone on Friday afternoon, evening, or morning at some part of the globe. My name is Beata Lubińska and I will be leading this webinar, 1 hour or even more, depends on the questions we get by the end of the session. And we'll be talking about quite emotional topic, FTP, funds transfer pricing in banking industry. Before we go into details, let me introduce myself. So I'm a treasurer of a bank based in London in UK. I'm leading treasury department, managing intraday liquidity, interest rate risk in the banking book, so all hedging strategies, funding strategy, and funds transfer pricing, plus some behavioral modeling because it's always part of our balance sheet management strategy. I'm also an author of 3 books. The first one is on the optimization, second one covers interest rate risk in the banking book, and the third one, which is going to be released in November this year, is on the bank treasury management. So I would like to just provide you with some rules for today's session, just to make sure we are covering everything as planned. So let's leave all questions to the end of the session. I will provide you with the introduction to funds transfer pricing, because we are going to do the deep dive in the FTP ocean during our seminars. And the seminar, as you know, is divided in 4 weeks. Each week is focused on the particular topics. So the topics are divided in 4 groups. The first one is focused on the FTP and balance sheet optimization. So how to optimize the balance sheet using FTP. So we will be talking through the incentivization scheme. We will be talking about the management overlayers. We will be talking about, how we can potentially steer the shape of the balance sheet by FTP. The second topic which we'll be covering on the day 1 is obviously what are the objectives, what is the scope, so all products. So I call it the FTP landscape, because we have always some products which are in scope of the FTP framework. Not all products are in scope, and we will be showing exactly what are the products which are in scope. And also during the first week, we'll be also covering the case studies. And I prepared for you guys for the session, not for today, but for the session which starts in October. Quite interesting, in my view, case study, because we'll be looking how exactly, we can optimize the shape of the balance sheet looking at the FTP framework. So this is the first week. The second week is focused on the FTP pricing, and we will go deep dive into the product pricing. We will analyze the multi-phase loan pricing. So the multi-phase loan is the one which has, in terms of the interest rate risk, these 2 phases. The first one, when we will be having 5-year fix, for example, 5-year or whatever it is, usually it's 5-year fixed term, and then after the 5 years, it is reversing to the floating rate or to the tracker, so to the base rate, for example, in case of UK market. And this has quite interesting pricing methodology. So both from interest rate risk and from liquidity perspective, we will be discussing it during the second week of our course. Plus, we will be analyzing NMDs, famous NMDs product, non-maturing deposit product, which is quite difficult to price. And this is where we slightly deep dive into the behavioralization concept. The concept of behavioralization, which is one of the most critical concepts of ALM, asset liability management, because it drives the whole life of treasury department day by day. And we will be also discussing the equity pricing, equity transfer pricing, sorry, I should say, and return on equity, where FTP fits into this whole equation. This is the second week. The third week, obviously, is the FTP curve construct, because FTP curve is also not trivial task to set up. It must support the business strategy of the bank. It must reflect our objective, and it must drive the objective of the bank. So it's not easy. It is different for different business models of the bank. So this will be the week 3. And during the week 4, there is full deep dive on the contingent liquidity pricing and contingent liquidity allocation methodology. Because as we know, we can do it through behavioralization, we can do it through the methodology, which I call separate from behavioralization. So we are not doing it through the curve, but we are doing it through the separate mechanism. Let's call it like that at the moment. So let's start. Ed, if you can, thank you so much, show the slides. So I've prepared for you 81 slides. We are not going to go deep dive through all of this because obviously we won't have time today, and I know this is Friday, so we won't be going through every single concept, but I really would like to show you what FTP is all about. And let's talk a bit about FTP before. Okay, I usually start all sessions with this main 5 pillars for commercial, conventional banks business model, and 5 important points which we need to think of once talking about banking industry. So definitely there is leverage concept, because a small capital base is invested in the asset pool, which is much bigger than this equity invested. And this is typical for the banking industry. It's not typical for other corporates or firms. We have the concept of maturity transformation, typical for ILM. So when we talk about funding strategy, when we talk about optimization of funding strategy, we always talk about maturity transformation. So basically, banks do portion of the profit, of income, because of maturity transformation. So maturity transformation is embedded into the business model of banking industry. And it's okay to run some portion of healthy maturity transformation. Of course, we know that in the past, maturity transformation, excessive maturity transformation, led to many problems. This I'm referring to the financial crisis times, when we have seen this not only over-reliance on the one source of funding, but we have also seen this excessive maturity transformation adopted by banks in the past. Then there is this concept which we don't, maybe in ILM, we practitioner in ILM, we don't realize on the daily basis, but it's there. We always assume when we do the funding strategy, or we are trying to, come up with the best funding sources to support the business of the bank, we are thinking about liquidity as always existing. So we will be always able to roll over the funding. So if this is the term funding, which is under expiration, we always assume that at least a portion of this funding, we will be able to roll it over, or like for like, or for whatever, other maturity we would like to do it. And this is interesting because we are not always, as we know, as indicated by the past, we won't be able always to roll over funding. And this is quite important to do the proper stress test and to see to which extent we are exposed to this kind of risk of rollover or not able to fund our asset side. Then we are talking about risk management. Of course, banking industry is playing also a social role. So it is important that there is this is imperative to have the robust risk management function or second line able to challenge the first line, able to support, the oversight of treasury risk and to challenge whenever there is any error or any potential or weakness on treasury side. We have the second line promptly showing us and mitigating. Regulatory compliance, we know that all regulatory landscape is very heavy. And it is increasingly heavy. And this is obviously for the good reason, because banks are playing social role and regulator cannot afford that something goes wrong. Of course, we have seen and we'll be discussing some past case studies. We'll be talking about Silicon Valley Bank. We'll be talking also about a bit about RBS and other banks which faced some problem in the past, and we will be talking potentially about the reason what could be done better to avoid these problems. So this is banking industry. These are the fundamentals of banks. And ILM is this function which I call bank within a bank. Why we are calling it like that? Because you will see that in the central model, FTP adopted as the central model, we have ILM function playing the role as a bank within a bank. So increasingly important department. The role of ILM is constantly growing, and you can easily understand why. The responsibilities of the ILM department are also growing. So there isn't a need for the sophisticated methodologies, for the sophisticated framework set up of the ILM function to be able to support the profitability enhancement strategies, because this is the proactive ILM which we will be talking about today and during the course. So ILM here in this presentation is the term ILM is used interchangeably with Treasury Department. So when I speak, I refer to Treasury Department, I will be also referring to ILM. It's not always the case. I want to be very clear. Sometimes ILM is not under Treasury Department. And in this situation, we cannot obviously use the same terminology. Treasury is much broader concept. ILM is part of Treasury Department when it sits under Treasury. There is much more under Treasury. So, but we will be deep diving in ILM today, and we'll be talking about FTP as a tool which ILM or Treasury has to, support the business objective of the bank and the strategy of the bank. ILM was not always the same. ILM department was evolving, and this is again the evolution which you clearly see over time. At the beginning, it was very reactive department, which was focused mainly on executing the hedging strategy. If we have too much exposure, we were close to the limit, close to the management trigger, and we needed to close the excessive time bucket sensitivity, or we wanted to slightly reposition the repricing gap of the bank, and we were using the hedging through synthetic hedging through derivatives, for example, or natural hedging, whatever it was. But it was very reactive, mainly focused on interest rate risk, because at that time liquidity was not a problem. As you know, Basel at the beginning was not focused on liquidity. It was mainly focused on capital, or the only point which at that at that time was analyzed was potential problem within a bank because of the capital or shortage of capital or mismanagement of capital, not about liquidity. Basel III introduced liquidity as the fundamental concept which needs to be also looked at. It doesn't mean that in the past ILM was not looking at liquidity. I'm not saying that. I'm just saying that at the beginning, ILM, because of the situation, was mainly focused on interest rate risk management, so hedging strategy. With time, the situation changed. So we have seen more and more, interaction between liquidity and interest rate risk. We started to see this concept of ILM optimization or strategic ILM, where we have seen, the multidimensional approach to the management of ILM risks. So when we managed one kind of, so basically managing ILM on the silo basis doesn't work. It must to be holistic approach where we know what is the impact when we manage one risk on the other. Funding strategy is interrelated to hedging strategy. So if we don't look at this together through the same lens, then we are probably mismanaging or we are suboptimal, at least suboptimal in terms of the ILM management. Okay, so we use this term of ILM at the center, so bank within a bank, which plays definitely this optimization role, this proactive role. And how does it work? So where are, this main tools, or how does it, the building blocks of this whole structure? This is the central structure. This is how it is called. Sometimes in the FTP language, we are calling it maturity matched funds transfer pricing, where we are referring to this central model where at the heart of everything is this ILM treasury department, and there are other stakeholders obviously related to ILM somehow, and we see how. So three stakeholders, at least three stakeholders, because there are also other departments we are deeply involved, but directly we have three stakeholders. We have asset center, we have liability center, and we have the central unit. ILM, as a bank within a bank, is providing funding to the asset side. It is obviously not really physical providing of funding, although Treasury on the daily management obviously is providing funding to the business units, to asset side, to be lent over to the customer. So definitely there is also, we are providing funding. We are making sure there is enough funding on account. There's that we are always full funded in terms of the accounts, and all products is always managed on time when we are delivering the liquidity to the products or to our customers. So Treasury is definitely looking at this as well. But in this particular picture, we are talking about rather a virtual, allocation mechanism rather than physical exchange of funds. So Treasury provides funding to the asset side to be lended over to the customer, but everything has its price. Liquidity is not for free. In FTP concept, liquidity has enormous value. We are calling it liquidity value of products. So some products will consume liquidity, and this is what assets are doing. Assets are consuming liquidity for some period of time. Liabilities are providing liquidity to the bank. So this liability center will be providing liquidity to the asset, to the ILM unit. And in this way, ALM has the liquidity to pass over to other, business units which needs liquidity. However, as I said, FTP will be this tool to manage the price of or value of liquidity. And let's see how it works in detail. So I appreciate you can see some numbers here, but I can assure you it is not so bad when we start, analyzing every single aspect of the slide. It becomes pretty clear. So you see that loan, the asset center here, we have loan division, is originating 2-year loan to the customer, to the customer of the asset side. Imagine in this particular example, it is all-in rate 11%, 2-year loan. Of course, we need to fund it. It is the consumption of liquidity for 2 years. If it's bullet, if it's amortizing, it is less than that, not taking into account any prepayment aspects, which must be taken into account, like we will see later, that it is fundamental also to have this overlayer of behavioralization in FTP. So 2-year loan, 11%, is consuming liquidity for 2 years. So this asset unit will be charged FTP rate by ILM, by the central unit, let's call it central unit, for liquidity, because they are using liquidity of the bank for 2 years. They have to pay for this. There is no free meal in FTP. On the other side, we have the liability, which are providing us, in this particular example, with 3 months deposit. This deposit is paying 4% to the customer. So this is, depositor placing money with the bank and getting 4% for funding. But this funding contractually is 3 months. Now, let's not enter into details. Actually, FTP is executed on the behavioral basis. You are right. We will get to that. But imagine that in this particular case, 3 months is the term of deposits. Of course, they are providing liquidity value for 3 months. So 3 months liquidity value, it is not the same liquidity value which when we have from, 5 years funding, or potentially sticky liability, sticky CASA, current account, savings accounts. So it's not the same, but it is liquidity value, which we have provided to the central unit. As such, they are remunerated for this liquidity value. And how? Through FTP rate. So asset center is charged FTP rate, and liability center is getting remunerated the FTP rate. Very important point of this mechanism, central mechanism. You see that they are paying 2-year FTP, the asset side, and they are getting 3 months FTP rate in terms of the liability side. So the maturity, this virtual maturity is matching of this virtual transaction, the maturity of virtual transactions is matching. There is big implication coming from that. It means that there is no risk, financial risk, coming from business units. The risk has been transferred from the central unit from the asset and liability unit to the central unit to being managed for management. And you see that we have fixed the margin, the spread between on the asset side, on the liability side, and this is basically fixed for the whole life of the transaction. Here we are talking about FTP allocated at the transactional level. Only when we have some cohorts of products with similar characteristics, when basically it's not we are not FTPing them with one. Every single transaction is not recognized with one single FTP, but we have for the whole cohort one FTP. This is for overdrafts, for NMDs. These products, so without deterministic maturity, are usually getting FTP on the portfolio basis, but all other products has FTP allocated at the transactional level. And this is what this central model is about the granular, very granular and transactional level view for each product. This is why executing this central model, you need probably the system, FTP system, ILM system, which help you to execute the central model transaction. Otherwise, it would be very difficult to do it otherwise. So you see this fixed margin on asset side, liability side, so 2%, because obviously the deposit side has the difference between the FTP and the rate which they are paying to depositor. So 6% minus 4% is 2% margin for them. And asset side is the difference between all-in rate on the loan and the FTP, which they are paying for funding, for 2 years funding. So 11 minus 8, you have 3%. Okay, that's fine. You don't have any risk on the business unit level. So the risk has been transferred from the business unit through FTP to the central unit to be managed. So here we see the ILM division or treasury division full of mismatches, because you can imagine this is only one transaction, but they have obviously a lot of transactions on the balance sheet. And if we assume that everything goes with maturity matched funds transfer pricing, then we will be allocating to each transaction the FTP rate. This will be transferred through these virtual transactions from the asset center or liability center to treasury, and you end up with the risk, financial risk. This is where we have this financial risk exposure, because you see already what's going on the treasury level at the central level. We get 2-year FTP from the asset side. We are recognizing 3 months FTP on the liability side. So we are paying to the liability center FTP rate. So you already see that on the asset side, you have on this FTP balance sheet, we have 8% on the asset side and 6% on the liability side. The difference is 8 minus 6, 2%. So this is like treasury spread, which is driven by something. By what? This is driven by the maturity transformation, because we are not matching here maturity between asset and liabilities unless we are deliberately, Treasury Department wants to deploy something which is known as match funding. So we will be matching deliberately because of some strategy which treasurer has in mind to match the asset side with liability side to avoid NII sensitivity and to avoid volatility. But other than that, every bank, every treasury department is managing these mismatches on the daily basis. This is our job. So we are hedging it. We can decide to hedge it if Treasury thinks that the exposure is excessive, or if Treasury runs this proactive strategy where they want to position the balance sheet or position with them or in line with the view of the market. So if market believes that the rates will be moving up, then obviously if we have net asset position on the medium long end of the curve, we will be closing it fully, almost fully. There is no full immunization strategy on the balance sheet because it's not possible, but we will be closing as much as possible this time bucket sensitivity on the medium long end of the curve. And if you are net asset position, and just the other way around, if you have the net asset position and you expect rates to be moving down, you will probably allow yourself as a treasury department, as a treasurer, to get a bit more exposure when in comparison to the situation when you expect rates moving up. So this is this proactive management. Everything is obviously within the limits. I don't need to repeat it. It's obviously we have the limits, we have the constraints, balance sheet constraints, which are for us as a Bible. So we are not going to even close to those limits. But always you have some discretionarity to manage the positioning of the balance sheet. Similar, as I said before, that we need to look as Treasury Department about how to integrate the management of the liquidity funding, IRBB, credit spread risk, market risk. It's all interrelated, and FTP overall, because FTP will be there, and you will see very soon how FTP works here as the strategic tool to manage the balance sheet. But before we look at this, we need to get this clear picture. So why it will be acting like that? The FTP will be used as the strategic tool. So look at this. Treasury is actually having a balance sheet in front, has inherited, I used to say, like inherited those exposures from the business lines, the risk, the margin, ILM margin, there is no risk there is only commercial margin on the asset side, on the liability side in this particular level, at this particular level, asset side, liability side, the margin is only driven by commercial activity. So all the business unit needs to do is not to worry about what is the impact in terms of my riskiness of the transaction, but how well I can promote the product, what is my relationship with the customer, and what can I do to improve the relationship with the customer and to push for the new good products for the customers. This is what business units will be doing. Meanwhile, Treasury will manage all these exposures, and there are many exposures coming from the products. As you know, we have the repricing, we have optionality, we have behavioral optionality, automatic options embedded in the balance sheet, we have basis risk, we have the credit spread risk, we have FX. So there is the full spectrum of different risks which we are managing on the daily basis. Plus, obviously, there is the funding strategy, intraday liquidity management, and much more on the top. So let's look at this, what FTP does for us in this particular maturity matched FTP model, the central model, when you have clearly isolated the P&L at the product level by asset side, liability side, and at the central unit. Now you want to see what is the profitability of each single product, because it's different. So when we are talking about asset, 5-year bullet asset, consuming liquidity for 5 years without any pipeline risk. So there is no pipeline, no early redemption of the loan. And then you look at the product which is long term, with potential early redemption, which the product goes through the long pipeline. So there is also the pipeline risk which Treasury has to manage. Yeah, of course, the loan will be sitting in the pipeline, so I need to execute the strategy if I expect that the rates will be moving up. So this is exactly what happens, how we look at the products. We need to assess the financial characteristics of this product before we price the product for FTP, from FTP perspective. So each product has different risk level, different characteristics, and the product FTP will reflect potentially the riskiness at the product level. But it is also the clear view of the profitability. So added value to the balance sheet, which comes from each product, or there is value destroying product. There are some products which are destroying value of the balance sheet rather than adding the value to the balance sheet. And this is exactly what FTP will help us to see, because without FTP, we won't be able to see. What exactly we won't be able to see? This risk-adjusted profitability of the product. This what is exactly the one of the main objective of FTP, to see the risk-adjusted profitability of the product. Let's look at this. I love this graph. This is coming from the article written by Hovik Tumasan. I hope I pronounced correctly the name, Revisiting Funds Transfer Pricing. And you can see that we divided the P&L. This is the P&L. This is the P&L of the bank, overall P&L of the bank. And then this P&L has been split between the business units of asset and liability. In this particular case, we have asset. We have only profitability of one product on the asset side for this example. And you have this FTP book, which is exactly this ILM, the book, the ILM sitting in the middle. And you see that when you look at the bank without FTP or without FTP glasses, you see that there is asset of 1,000 unit, founded by liability of 1,000 unit. We have the 5-year asset, which is earning for the bank 6%. And this is funded by the liability, 1-year liability earning 2%. Clear maturity transformation, clear rate transformation. So at the bank level, the net interest income in the net interest margin will be 4%. Yeah, because profitability metrics is NIM. So we have 6 minus 2, 4%. Fantastic. You see that the bank generate NIM of the bank is 4%, but this is not the full story. In order to understand what is the driver of this P&L, you need to see the FTP. Through FTP, the true profitability of the product, or the true added value of the product, or if the product is adding value or destroying the value. And this is where you see the split. So you see on the asset side, you have this 1,000 unit of asset, and we are matching with this virtual liability. This is why we are calling them shadow liabilities, exactly by amount, by volume, and exactly by tenor. So we see that this asset is paying 5-year FTP. How we identify that the 5-year FTP is 3%, this is another story, because we will be constructing the FTP curve, which is the benchmark, which provides you with the FTP rate by tenor. And then we will get this marginality concept, which is embedded in the maturity matched FTP or the central unit FTP. Not always the case, but this is the marginality concept is the one which we want to operate when having the robust FTP and good FTP, transparent FTP process. So you will see that overall on the asset side, you have the NIM of 3%, because the difference between 6% all-in rate, which the customer is paying to the bank, and 3%, which is the FTP for 5 years, is 3%. So we see that this asset is generating NIM of 3%, but we said that the bank's NIM is 4%. So where is this additional 1%? So if you thought at the beginning that this 4% is fully generated by the asset, it's not the case. We have 3%, which is generated by the asset, and the rest is actually generated by treasury or by FTP book. Here we are calling it FTP book because we are running risks. So this is the NIM or ILM margin at risk. It's not realized margin. It is the ILM margin at risk because you are running risk of maturity transformation, and in this particular case you are facing the risk or the risk of the future volatility of cost of funds, 4-year cost of funds in 1 year time, because obviously you have the 1 year is locked in. This maturity of deposit is 1 year. So for 1 year, you have your margin closed. But after 1 year, the margin is open. The ILM margin is at risk. So it is up to Treasury to manage it well so that you can enhance the profitability of the bank in the healthy way rather than destroy it. So you see that FTP is this good mechanism to show you, or the best mechanism to split the margin, to transfer the risk from the business unit to the central unit, and what else? So we already tackled 2 points of the objective of FTP, but we have much more when we talk about FTP. As I always say during sessions where we speak about FTP, FTP is an ocean. You have so many aspects to cover, and this is just the introduction, obviously. So you see that we seen this FTP as a adjusted by risk product profitability. So you can clearly determine which is value adding, which is value destroying. And this is something takeaway message, which I would love you to take with you after this short webinar. Then you have another aspect, which is balance sheet management, because as we said, we are transforming the risks from the business unit to the central unit to be centrally managed by one unit. And this one unit is ILM Treasury Department. So what is the benefit of having it centralized rather than decentralized? Because you have person or team which is looking at the risks at the central level. So you see everything, at the helicopter view, which I like to call it. Of course, you are going very deeply. Meanwhile, you analyze each time bucket sensitivity or your exposure to different risk. But my thing is that you see what you know what you will be looking for. You know where is the weakness of the balance sheet. You know, therefore, what is the optimal shape of the balance sheet for this particular bank. Because where is the profitability sitting? Not only what products provides the profitability to the balance sheet, but there is also this, balance sheet optimization or optimization of your asset and liability management. So ILM optimization, which can support the profitability, and it is definitely the profitability enhancer. So this is why FTP is also this providing the possibility to enhance the profitability of the bank. And we will be looking at each strategy. So we'll be applying the management overlayer, we will be dampening the curve, we will be marking up the curve, we will be looking at the curve liquidity premium once we will be setting up the FTP curve. And then it is obviously the main building block for the product pricing. And we said we have so many aspects to cover once speaking about the product pricing. So we price differently the amortizer to bullet. We price differently the floating rate asset and the fixed rate asset. We price differently NMDs and we price differently the term fixed term deposits, and also the off-balance sheet products are priced differently. So this is what is meant by building blocks for the product pricing. FTP is this first building block because you start with FTP, and there is the case study where we will be during the course calculating the return on equity, and we will be calculating each single component of FTP driven by which is all in price, the product price, but what is exactly inside, this is where we need to dissect this by single elements. And then there is liquidity management. You know that one of the big important tasks of Treasury Department is not only focus on the funding strategy, but also, managing potential excess cash position or, potential, hopefully not, liquidity shortage. When you have the excess cash position, you have to invest it or you have to do something with it. So especially when, you have limited possibilities, it matters where you place this liquidity. When there is the negative cost of carry, the lab is the cost driver rather than providing you with profitability, then you have to make the decision wisely, because otherwise it will be the profitability drain rather than enhancement strategy. So this is another thing. You see how you manage, where is the excess, from where the liquidity is coming. First of all, you know it through FTP. You know what is the most requested tenor of your balance sheet. You know what is the tenor most popular, let me call this word, popular tenor on the liability side. What is the most attractive term on the liability side? So this is where you gain insight into the funding mismatches, and you can therefore develop central responses of solutions. This is why this is important to have it central. So just 4 purposes of FTP in the balance sheet management, but it's not the only one. Those 4 is just the most important one, because FTP also, can adjust for certain situations. Imagine you have the asset which is profitable, and as I previously mentioned, is plain product without any embedded optionality. It's contractual product, and you know that it is no early redemption there. So this product, it will be priced accordingly, and this product will be obviously gaining some profitability to the bank. And then you compare this product with another one with longer term amortization schedule, embedded optionalities. So FTP will be obviously different. So how you want to structure the shape of the asset side is the part of the commercial strategy. But once you have this commercial strategy in mind, then you will drive the shape of the balance sheet through FTP. So what can you do? You can charge more the product which is value destroying to your bank. Let me show you exactly this slide which I wanted to show you. So this is exactly what I meant. I think, okay, let's stay here. So you see this FTP shape. So imagine that the 5-year product is the one which you want to disincentivize, because it's driving you the negative margin. So you will be using the tool which is incentive premium. So you will be applying some kind of malus or some kind of negative incentive to the product, so they will be paying more. So you will be basically charging them with higher FTP. So because you want to see certain behavior, you will be steering your balance sheet to achieve certain behaviors. From the other side, imagine that you want to incentivize certain liabilities because you want to have them, to close slightly the mismatching between asset and liabilities. You want to reduce the level of maturity transformation of the bank. You will be driving longer the tenor on the liability side. And how you can do it? You will be incentivizing the long-term sticky liabilities also through FTP. So for this particular product, you will be providing them with the incentive through the FTP. So you'll be getting them higher FTP, so that when they get higher FTP, they will show better profit and they will be incentivized to do more. This is the reaction which you hope to achieve through these steering techniques. So incentivization and balance sheet shaping can be achieved through at least two tools, as we said. One is the incentive premium, which is applied by the single product level, is usually applied in the short term time, is reviewed after this short time period to check if we are achieving the objectives or not. If we are achieving the objective, then we are withdrawing basically this incentive premium scheme, because we don't want to damage the structure of the balance sheet. So it's only for the some period of time. Or you want to place some structural tools, which are, or I call them management overlayers. There is also some Bank of England called them also management overlayers in their review of the FTP framework for banks. So this is when you are dampening or you are changing the shape of the FTP curve to achieve certain objectives. So this is what we are calling the management overlay. And here you are going with the whole structure of the FTP curve. You are putting it down, so dampen it, or shaping it, marking it up, so you achieve certain behaviors. And we will be, during the course, going exactly through those tools and creating some or analyzing some situation when we can see how it works in detail. Given that I'm here, I also would like to mention some building blocks of the FTP rate and how is it, what is exactly FTP and what is not FTP, because the price of the product is obviously not all FTP. So we call FTP, which is the cost of ILM risk. I call it cost of ILM risk, because you have at least two building blocks. You have the base rate, so you have the risk-free curve, which is typical for the market where you are operating. So, for example, Sonia curve in UK is considered the risk-free curve, and this will be your basic element. Or sometimes we say this is the cost of hedging interest rate risk, and we will be calculating this. It's not calculated, it's basically taken from the market. So, or you will calculate it if you are in the location where the curve is not liquid. So you have to think how to construct this base curve, because the market is not liquid and there is some embedded, it's not considered risk-free. So you need to adjust the curve, you need to think how to construct the curve. And for example, there are currencies which in Turkey, for example, or in other location, when you don't have you cannot say exactly, because there is no liquid market, that this is risk-free curve. And instead, in UK or Europe or developed market, you can always say that this is your curve constructed based on the swap or govie bonds. You will construct this curve easily because it's liquid. And then you have, so this is the concept which is for all products. If you have the 5-year product, this will be the base rate, the ITP component of the FTP, interest transfer price. It's ITP for all products which has tenor 5 years. Meanwhile, this is the term liquidity premium, which is the second big component for of the FTP rate, which is considered the riskiness of the transaction of the bank itself, not the transaction. It's not of the customer, riskiness of the customer. It's the riskiness of the bank itself, the institution itself. Because you know that if you are talking about smaller bank, obviously they are fighting for deposits, they are fighting for funding, they are fighting for, if they have the access to the capital market, they are paying the higher premium in comparison to the banks which are well established in the market and where they are operating, they have some brand and the customer know them well. So this will reflect the riskiness of your institution in the external market. So it's typical, this TLP, term liquidity premium, which will be always for the whole journey for FTP. We'll be talking about ITP, LTP, and call. Call is the cost of liquidity or contingent liquidity cost, which is the next component of the FTP. Although I've heard many times, and I don't argue this, but many times I've heard that some people, FTP practitioners, who are saying, no, it's actually not part of the FTP. When I'm saying it's not part of the FTP rate, we have to charge out anyway the cost of contingent liquidity, because contingent liquidity has some cost, especially when there is negative cost of carry, and funding lab is higher. The cost of funding lab is higher than the yield we are getting on lab. Then of course there is negative cost of carry, so we need to charge it out to the business, which creates this cost of contingent liquidity, or cost of why we need, or the need to hold this additional liquidity in the form of lab. And then we have the incentive. Incentive premium is the next element of the FTP curve, FTP rate, not curve, rate, because as I said, this is part of the strategic FTP. So we'll be shaping the balance sheet so that the business objectives of the bank are achieved. And then there is the whole portion of not FTP. So we have the credit risk, and net margin, product cost, because obviously the production of the product, because the origination of the product has its own cost. So it's not, it has to be included. We are passing it. Some portion of cost is passed on the in terms of the final rate. So we have this main 4 elements, I would say, of the FTP. This is not FTP. So when we are referring to when we refer to FTP, we are talking about this building blocks. We have additionally, let me just summarize the introduction to FTP with another concept, which is, in my view, important. So the FTP curve. this is the part of the pricing. I have it all in the deck, and there is much more in the final deck. Of course, we'll be analyzing in details every single product, but behavioralization aspect, where we will go through the how we model NMDs, what is this core portion, what is this rate sensitive portion, how do we price them in terms of the FTP. But then we will very in detail focus on the FTP curve. This is, apologies if I'm jumping a bit, but it is FTP techniques of curve construction. So how we construct the curve. And I will focus on those three models when we construct the curve. So we have basically one with the focus on the funding side. This is typical when banks are going through the asset momentum. So they are full gear to expand the asset side of the balance sheet, and they will be using the deposit, and not only deposits, but also they need additional funding to fund the growth. And this is where we will have this FTP model or FTP curve, which is focused on this capital market additional funding, because we are answering the question in this situation: how do we find the additional one unit of the new asset, or of the asset growth, not of the asset base, which is already there, but new, how much it will cost me to found, to originate this one unit of asset. This is what we will be answering. We'll be answering the question, and this is where we focus on this additional funding sources through the capital markets, for example. This is where our FTP curve will be reflecting the on the long end or medium long end, will be reflecting of the cost in the capital markets. The second one is just the other way around, because we have a lot of deposits. We don't have sufficient expansion on the asset side through loans, and we will be investing these loans in some part of assets, or in the lab or other assets, securities, for example, on the treasury. And we will be trying to define this FTP curve, which reflect the business model in this second case. And then the final one, which is common now, is the one which is driven when we have, more equilibrium between the asset growth and liability. In terms of the composition, there is this focus on the very much on the funding diversification, but also on the asset diversification, and the asset growth is, tailored or in line with what we have. This is exactly the situation which we have now. Yeah, we want to grow, we want to operate the healthy strategy, but from the other side, we are also, we need to think about how we fund the asset side. Is that sufficient, funding sources which are provided by product X, Y, and Z. So this is exactly the template for how to structure the funding curve for this case study. And we will be analyzing the case study, which is based on this third example. So I will show you the first one, the second one as well, we will discuss, but the third one is the one which we will be constructing during our session, and we will be analyzing. I also will cover some, this is the last part which I would like to bring during this webinar, is the last part is methodology. As I said, this is why I'm jumping, because I have so many slides, and there's part of the full deck, of the main deck, so apologies if you see me jumping, but just wanted to show you how we can define the FTP methodology. So FTP methodology is exactly, it was at the beginning. So how we price the NMDs, how we price the term asset, how we price other products, and how do we quantify the prepayment? How do we quantify the fact that the assets are subject to the early withdrawal? So in case, for example, of FTDs, which can be withdrawal earlier or broken, early withdrawal. So this is again how methodology. FTP is divided in three. There are three components of FTP, I would say. The first one is landscape. Four, I should say. First, landscape. So what products are subject to FTP? Second one is the methodology. The third one is FTP curve. The fourth one is governance. Of course, governance is very important because this is, given that it's so strategic tool, then we need to make sure everything is transparent, is design, fit for purpose, and everyone understand at least at higher level how they are pricing from, and there has to be some documentation, FTP practice guide, which are describing. You have to be aware, if you are implementing the management overlayers, what is the profitability of the bank before and after, if you want to subsidize some or a portion of assets, because you can do it, but you obviously need to document why you are subsidizing and what is it for. You need to calculate before implementation of management overlay and after. So this is very important. Documentation is everything. Also, if you are doing the incentive premium, you have to document for how long, what product, what is exactly the amount of this incentive premium, and so on. Ed, I would have, this is the presentation which I had for now. I would like to now open the floor for questions. So we can remove the presentation and we can go with question. Thank you so much. So please let me know if you have questions. Capital markets. I'm having doubts about the concept of liquidity premium within FTP. Does liquidity premium include credit risk, or is it just the additional compensation a bank pays for locking in funding over a longer horizon due to liquidity risk, market conditions, and funding costs, excluding credit risk? Okay, very good. A very good question. Although we would need to go a bit more in details. So imagine you are constructing the funding curve for the model number one. So you have wholesale funding, you are originating bonds, you are issuing bonds, senior debt issuance, and this is what will be reflected in your FTP curve. Now, imagine there is a bad news in the newspapers about you. You are subject to the idiosyncratic risks, because of course any bad news will impact your reputation. What happens with the quotes of your senior debt issuance? It will be obviously reflected. This bad news, it's highly volatile. The quote in the bond market will be subject to volatility, also driven by some idiosyncratic concern, not only market concerns, but also idiosyncratic. So there is the element of credit worthiness of the bank itself, which is included in this term liquidity premium. Also, let me provide you with another example. Imagine you have the bank which is funded 100% by deposits. So you don't have any access to capital market, or bank does not envisage at this particular point in time access to the capital market. So you don't have this market quotes. You need to somehow understand what is the TLP for your liabilities, and there is still some component of own creditworthiness of the bank. Why? Because for smaller banks, for banks which are entering the market, for start-up banks, you need to fight for deposit, and you are price taker. Obviously, you are taking price because you are watching the competition. You have to price liquidity, for example, because the customer are very knowledge savvy. They know financial markets they quite well, especially in in our market. I can tell you that I see it very clear that customer are rate sensitive. They watch price, and they want better rate. So we need to compete. We need to price it. Smaller banks have to price higher. We have to price higher. This is the typical, reflection of our own, of the fact that we are small, we are not well known. We need to compete. We need to recognize additional premium for the fact that we are smaller, not well known, and in comparison to banks which can ensure much cheaper funding because they are well known, bigger, and there is also the typical aspect for the market itself. But as I said, there is component of the credit worthiness, and the TLP is meant to incorporate this. So it's not the credit risk of the asset side, so the customer itself of the asset side based, but it is credit worthiness of the institution itself. Any more questions? Let's take another one. If I may ask, how can FTP be effectively applied in markets that are relatively illiquid, where there are limited market instruments to build reliable FTP curves and transfer rates? In such environment, what practical approach or proxies can bank use to ensure FTP remains meaningful for performance management and balance sheet management? Excellent questions. Excellent question, and we will be dedicated. We will have dedicated session to. I will show you 3 examples how to construct FTP curve in liquid market. There is quite a lot to analyze in this situation, because you have to see. To create proxy curve, you need to see what market you are, what is the correlation of your currency or the currency of the market you are operating in with the some hard currency, so the one which you are fluctuating around, because there is always this correlation. And if imagine it is USD, then you will do some proxy, and there are some methods to do it, but I would rather not enter into details because it's quite complex stuff, and I would need to show you some, equations, how we will be transferring it, examples. Otherwise, it would be very difficult to describe. But there is very well-designed mechanism to construct it, and there are 3 methods. No, I'm going to show you at least 3 methods to create the proxy curves for this situation. Then let's have another one. Okay, I don't see other questions. No, unless I'm missing something. If not, a new message received. Okay. Is the FTP rate reflecting the true cost of risk for profitability analysis? Yes, Absolutely, but this is not the only one element you need to look at once you are doing the profitability analysis. So, cost of funding or FTP curve or cost of all other, ILM risk. I call it ILM risk because you have also optionalities. You have some, basis risk adjustment. You know, many components which are covering IRBB or the hedging of the balance sheet and funding of the balance sheet. But you have also on the top some other components like, what is the operational risk, what is the capital which is allocated to asset itself. So we will see the example how we calculate the return on equity for the product, for the asset, particular asset with particular FTP, and based on risk weights for this asset, how we calculate the profitability, and we will compare with another product with different characteristics. So you will see how it changed. FTP the same, but different. For example, cost of credit risk. So then, this is not FTP, but it is also part of the profitability analysis. Any more questions? If not, I would love to thank you so much for your attention and your patience having me for 1.5 hours on Friday. I would love to see you all in our seminar organized by BTRM, by Bank Treasury Risk Management Certificate. And we will be going deep dive in details of all aspects, which I hopefully provided you with some, taste of what we will be doing during this course. Thank you so much for your attention, and I'm looking forward to seeing you in the sessions. Thank you.